Good morning, everyone. My name is Daniel Trinder. I'm a Senior Policy Advisor at Afore Consulting, and I will moderate the panel on the Supervisory Perspective, which will provide insight into the role of supervisors in the EU taxonomy framework. And in many respects, it needs to make sense of the framework and make it workable for the financial services industry. And most importantly, to do that, it needs to ensure the taxonomy changes behaviour in financial services, which is not easy to do. We're still waiting for two of the panellists to join us. So what I will do, given we've only got 60 minutes, I'm going to introduce the four panellists. So let me introduce and thank the panellists for their time and sharing their views. So let me start with Alessandro Deri, who's Senior Policy Expert at ESMA. And then we've also got Fabien Tennier, who's a Policy Expert on Sustainable Finance, Economic Risk and Analysis at the European Banking Authority. And we've got Charlotte Gardes, who's Deputy Head of Unit, Sustainable Finance, Corporate Law, Accounting Standards and Corporate Governance at the French Treasury. I can see you have a lot on your hands, Charlotte, so totally understandable. At the moment, we don't seem to have anyone from EIOPA with us at the moment. But I'm going to press ahead if that is okay. And just to remind the audience that if you have questions, please post them through the Q&A function, and I'll do my best to integrate the questions into the session. Maybe if I could start. Sorry, and actually, let me just introduce Pamela while she's just joined. Okay, so Pamela Schuermans, who's Principal Expert on Insurance Policy at EIOPA. So without ado, let me start. If I could turn to each of the three representatives from the ESAs. And maybe, Alessandro, I could start with you, and then Fabien, and then Pamela, just as she settles through joining us. If I could start and just ask your thoughts and really to give us sort of an overview of the work undertaken at each of your authority in terms of the advice you've delivered concerning the taxonomy relating to the disclosures, but also any tangential work that's related to that that's been going on. So, Alessandro.
Good morning, everyone, and thanks to Afore for the invitation. I'm pleased to share with you a few thoughts and a bit of an update on what ESMA has done in terms of the work relating to the taxonomy regulation. As Daniel mentioned, ESMA provided advice to the Commission in the context of Article 8 of the taxonomy regulation, in particular with respect to the disclosures relating to non-financial undertakings and asset managers. This advice was prepared after public consultation, which ran in November last year, and after quite some extensive discussions and consultations with the platform on sustainable finance, which is, as we all know, the institutional group established under the taxonomy regulation, which ESMA, as well as the other colleagues here from EB and EIOPA, is a member. I think there are three principles that I'd like to single out in our work on Article 8 on the disclosures, which may be useful to highlight for today's discussion. First of all, one key point in our advice in preparing the disclosures, we tried the requirements for the disclosures. We tried to emphasize the importance of consistency and building on financial statements figures. That was important for two reasons. One is that there is a long-standing experience and shall say tradition in the way companies and issuers prepare their disclosures in terms of financial reporting, so revenue, capital expenditures, operating expenditures. And therefore, we thought it was important to leverage on that sound experience in terms of accounting for these measures on the financial reporting side. The second reason for that was a practical one, to make sure that companies could have an easier access to this data. And when I say easier, put it in quotes, in the sense that nothing under the taxonomy regulation is straightforward, if I may say so, given that taxonomy regulation is a bit of a groundbreaking piece of legislation, and therefore it will require financial market participants to make changes to their systems. The data collection will be, in most cases, I would say in all cases, totally new compared to what they do today, in particular non-financial undertakings, but also partially asset managers. So trying to build and create consistency with financial statements was a way to leverage a bit on existing systems and data sources. The second point that I'd like to emphasize is the importance of complementing the KPIs with additional disclosures. And this is also something we have advised the Commission to do in the delegated act that hopefully will see the light sometime soon. The KPIs under Article 8 of the taxonomy regulation don't tell the entire story of a company's sustainability profile, neither the entire story of their taxonomy alignment. And therefore, it is important to complement the simple KPIs with additional information on what these KPIs signal, what the assumptions underlying those KPIs are, and other aspects. So this is very important to also help the investor protection perspective. A single number such as a KPI may be misleading if read alone. So again, it's important to read the information within their context. And the third point, in developing our advice, we also kept an eye to transition issues. When I say transition issues, I mean transition towards greener economy, and the fact that whilst the taxonomy regulation is quite binary in its assessment, it basically currently says either you're in or out. It is also true that companies will be on a trajectory to becoming taxonomy aligned, and this also needs to be transparently reported, and that's where the disclosures about the plans on capital expenditures become critical. In particular, ESMA proposed, and hopefully this will be included in the final delegated act, proposed that when capital expenditures are undertaken in order to ensure the future taxonomy alignment of the company within a certain time frame, well, these capital expenditures can rise under taxonomy, under Article 8 of the taxonomy, provided that there is a sound plan that explains how these capital expenditures fit within, say, a 3 to 5 years plan, or longer if needed, plan to make investments to become taxonomy aligned. So that's a very important point from our perspective in order to give the dimension of the transition towards a greener economy, and not just stick to what is already aligned, which is obviously very important, but it's only part of the story. If I may just make a last point on this, one other aspect I'd like to emphasize is that obviously the Article 8 disclosures do not happen in a void. They have to do also with the broader picture of the corporate sustainability directive, the proposal that the Commission has issued recently, and therefore it is important to also look at the broader picture there and see how the future Article 8 disclosures will interact with the future CSRD disclosures. So I'll stop here perhaps, and thanks again.
Thank you, Alessandro. Fabien.
Yes, good morning. I hope you can hear me okay. Thank you for the invitation. I'm happy to provide an overview of the EBA's work on sustainable finance, but for the discussion today, I think perhaps interestingly to note that what the role of the taxonomy is as part of the different mandates we are working on. And I think from the EBA perspective, it has been quite clear since the beginning that the taxonomy will be a key tool for the banking sector, and it has an impact on the work that the EBA is conducting on different aspects. So as you might know, the EBA has received a relatively high number of mandates from the legislators, covering the three pillars of banking supervision, so pillar 3, disclosures, pillar 2, supervision, and pillar 1, prudential treatments. And actually, the taxonomy is reflected in all of these mandates. So starting with disclosures, as Alessandro mentioned, the three ESAs have been working on the advice to the Commission on Article 8. And from the banking sector perspective, we think that the green asset ratio that banks will have to disclose going forward will be a key new metric to appreciate bank starting points, but also to see how this may evolve over time and to assess their strategies. On Pillar 3, prudential disclosures, we have published a consultation paper a few months ago. The consultation has just ended, and we will take into account the feedback received to develop by the end of the year final technical standards. So these disclosure requirements will apply to large and listed institutions, with the first disclosure beginning of 2023 and the financial year 2022. And as included in our proposal, the EBA's suggestion was to include in these disclosures information on both the risks to which institutions may be exposed, to transition risks, physical risk, and assets that may be particularly exposed to climate change related risk, but also information on the green side, if you will, or the proactive actions that institutions are undertaking, in order to get information and to inform the market also on the broader strategies of banks and of how banks are progressively adjusting their business models and to have a fuller picture of banks' ESG risk profiles. Of course, in this Pillar 3 template, there will be a link with the taxonomy because, for example, the green asset ratio will be based on the green asset ratio under the taxonomy regulation and based on the Commission delegated acts, and progressively extended to other environmental objectives, depending on the timeline of the taxonomy. In terms of Pillar 2, and by Pillar 2, I refer more generally to risk management and supervision, we have just published a report on the management and supervision of ESG risk, explaining how we think ESG risk should be incorporated in the banking regulatory and supervisory framework. And there are several references to the taxonomy in that report. Maybe it's less intuitive than for disclosures, but we see a role for the taxonomy as a tool to support banks' approaches to building a business model in the long term that will be resilient to ESG risk. So, for example, some use cases of the taxonomy that we outline in the reports is around using the taxonomy to develop indicators and criteria to categorize assets, also looking at the types of technical screening criteria used by the taxonomy, but also potentially when engaging with clients on what is their transition pathway and how far or close are they to the taxonomy criteria. Also, when banks design sustainable products, the taxonomy can obviously play a role here, and it can help to avoid greenwashing risk, for example. But also when setting strategic objectives and targets, for example, the green asset ratio indicates the share of assets that banks wishes to align with the taxonomy. So as a strategic objective, it can also be useful in the broader bank's approaches to ESG risk. So here I should note that, of course, by construction, the taxonomy does not aim to address all the prudential risk associated with the ESG factors. This is not how it has been designed. However, this is still a key tool for the banking sector, and we have to consider the role of the taxonomy as a cornerstone of EU initiatives on sustainable finance, the link with disclosure requirements, and more broadly, the supporting role the taxonomy can play for the banking sector. And just to mention the other mandates we are working on and what the role of the taxonomy is. So the EBA will also be developing tools and scenario analysis methodologies. We have published a first report, a pilot report a few weeks ago. One of the aspects in that report was to assess what is the state of play with regard to banks' implementation of the taxonomy, and starts to provide a first estimate of the greenness of the banking sector. It was assessed, of course, that there is heterogeneity across banks. There are also challenges to implement the taxonomy. At this stage, the first estimate of the green asset ratio was 7.9%. But of course, this number has to be taken with caution, because the scope, the choice of the denominator and the numerator can change the results. And finally, we will also be working on a mandate to develop a report on a sustainable securitization framework by the end of this year. The link with the taxonomy and the green bond standards regulation will also be explored as part of that mandate. And we also have a mandate to assess if the prudential treatment for exposures associated with environmental objectives needs to be amended. And here the taxonomy can also play a supporting role to define the scope of green assets, and in particular, going forward, to conduct risk differential analysis, because one important part when assessing the need for amending the prudential treatment is to have a risk-based, evidence-based analysis, trying to figure out if certain assets display a specific risk profile. So the taxonomy here will also be supporting that assessment. Okay, I will stop here. Thank you.
Thank you. A lot of work. Pamela, welcome, I should say. So thank you very much for your time and for joining us. Could I ask you, please, just to outline what EIOPA are doing, please?
Yes, good morning. Can everybody hear me? Yes? Can you
Yes,
hear?
very clearly.
Sorry. Good morning, and thank you for having me in the taxonomy workshop and in the panel with my colleagues Fabien and Alessandro. It's a pleasure to be here. And indeed, as Alessandro mentioned at the beginning, but just to be clear, as ESAs, we're the directly appointed members in the Commission's platform on sustainable finance. So that's definitely the angle where we have some involvement in discussing the taxonomy. But at the same time, independently as ESA, we also advise the Commission on these regulatory measures to actually implement the taxonomy, such as the Article 8 taxonomy regulation disclosures, but also the product-related disclosures on Article 5, 6, and 7. So just to say that we're intimately linked to taxonomy, but we have also different hats on it at some points. And I guess we have sufficiently discussed this morning with the platform the usability of the disclosure requirements. I don't think I would enter into that. And as Fabien said, taxonomy is definitely a building block, not specifically for the ESAs, but I think generally for sustainability initiatives across Europe, for sure, and hopefully also more globally, because this is what people call a dictionary, or it's creating this common language for sustainable activities, or to know what is sustainability. I mean, if we have to act more sustainably, what should we do? And by identifying these economic activities, it's of course it's guiding us. It's guiding the economy. It's guiding also supervisors, and that's why it can help, depending on the strictness of the taxonomy criteria. And I think this is also very much discussed. It can also help really as a safeguard against greenwashing, because many actors can say that they're sustainable, but who's going to set the benchmark? And I think that's what the taxonomy can really help us all in setting this benchmark, in having a safeguard against greenwashing. What do you assess sustainability against? And of course, the feasibility of achieving these standards, that's, let's say, the political angle. where you say, can we achieve all these choices and these options? But what we have to focus on is how usable is it? How can you usefully report on that? How can you communicate on that? What are relevant indicators by which you show easily that you are sustainable? And that's, I think, the key thing. That's what we will, as supervisors, will have to work with also later on. So as Fabien also said, it's pervasive throughout what we call pillar 1, 2, and 3, throughout let's say the risk analysis, throughout the governance, and also throughout the reporting. This is relevant for us. And of course, taxonomy is a part of sustainable activities. It's the really the strict sustainable activities, and how this feeds into the work of EIOPA. I can mention maybe 3 examples to start with, and I hope you can pick up on that later on to discuss, or I hope to get some questions on that. But first of all, I would really like to stress the specificity, if I may, of insurers in the sustainability context, because we've seen also at the initial phase of the discussions on taxonomy, there is a high focus on investments, fairly enough. So what do you invest in if you want to invest in a sustainable manner? And that is that was a perfect starting point. But what has been maybe not understood very clearly, and I think this is now also our role and the role of the insurance industry, to stress the point that insurers are not only large investors and as such users of the taxonomy. So they will look at the taxonomy and say, okay, how green is my investment portfolio, especially in the life insurance activities. That's why it's so important to have these product disclosures very, very well established. But the insurers are typically the risk managers of society when it comes to taking over risks against payment of a premium, risks that also rise from climate change. And you have these really natural catastrophes, the huge, unexpected, highly severe, but less frequent so far catastrophes. But there's also the ongoing, the slow onset, the chronic damages you get from more regular flooding, more prolonged heat waves, and these are not necessarily the natural catastrophes. And that is what insurers, typically non-life insurers, provide coverage against. And that is actually these 2 angles. As an investor and as a risk manager, insurers really play a role in sustainability. And that's where, of course, once you know what is a sustainable activity, this helps. And as EIOPA, I've heard before, indeed, Fabien touched on the double materiality. That's key. From the start, when we set up our plan, it is not only, and of course, typically it's useful for a prudential supervisor to look at the risks that climate change or sustainability risks cause to the insurer. So what are the financial risks? What are reputational risks? Anything. And we talk here of the physical risks and the transition risks that affect not only the investments, but also the liabilities. So because we see that the higher the risks become, the higher the premiums will be, and the higher the losses will be. So these are risks also on the liability side. So those are the risks, but we have advised the Commission to also take into account the fact that insurers have this role to play to minimize the risks towards society. So that's this double materiality, the outside in and the inside out. We know this by now, it's clear, but a few years ago, this was a big thing to say this explicitly. And that again is because insurers have a particular role to play as risk managers. And then we come back to the taxonomy. This has been acknowledged in the taxonomy. We've seen the Climate Change Delegated Act has explicitly set out screening criteria for non-life insurers to be eligible. So not just as a user, but you can, as a non-life insurer, become taxonomy compliant. Now, that is up to the insurer. Would they like to have that? For reputation, it's not a must. It's not an obligation. There is no punishment if you're not taxonomy compliant. But would you like to take this forward? And would you actually like to be a taxonomy compliant insurer? And that's in particular in the climate change adaptation area. So there are very strict criteria. And we would be happy then to see in the next months also how these can be implemented by insurers, because there are many criteria. And one of the criteria is also part of one of our work streams we've been engaging in recently, and we hope to publish then, well, not hope because it has been approved by our board, but we are aiming to publish our final report on what we call impact underwriting. And that's where it goes. That's one of the essential points we've been focusing on. Insurers can contribute to climate change adaptation as per the taxonomy also, if they invest in products, if they innovate products where they take into account prevention measures that reduce the risk and reduce the losses that are caused by climate change events, climate-related perils. And that is what we call impact underwriting. We'll publish a report on non-life underwriting and pricing in light of climate change next week. And that is really one of the work streams which has been, I would say, not easy to engage in, because insurers say, well, that's the purpose of our business. We try to reduce losses, of course, but we are seeking to establish in the insurance community more proactive involvement to really help policyholders to reduce the losses and then be better resilient against climate change. Because if you see that if climate change risks increase, the price for insurance will increase. And in the end, the insurance business will not be sustainable anymore. And that's a very important work stream, which is different from what we see in the industry, net zero underwriting practices, where it's about not underwriting certain non-sustainable activities, such as whatever, I won't get in, but that's different. You can choose as an insurer not to underwrite certain activities, but what you can also do is to underwrite the activity and engage in certain prevention measures. So that's what I wanted to highlight. And of course, I think, Daniel, I see you're getting a bit impatient. Maybe you see probably the questions popping in, but just to say that I can address also some points later on, if you want, on supervisory reporting. I think Fabien made the relevance to the Gardes. I think taxonomy disclosures will be relevant for risks, and maybe also for assessing risk differentials in the future, because what is the starting point, which sustainable activities? And then, of course, I think there will be a very important, and I would like to have this discussion, how will supervisors be able to actually supervise this disclosure? Because you have the information, what do you do with it? Who's gonna say that the ratio, I mean, you can check the accuracy, you can check whether it's reported, but all that is behind, what kind of assessment has the insurer made, and what data and information is behind that to assess really the sustainability. And I'm sure that there will be a lot of conduct discussions on how we supervise the sustainability of products and prevent consumer detriment that would arise from greenwashing. So that's to leave the big topic at the end. But that would be it for me. Thanks.
Thank you. I was going to say, actually, it's the clearest explanation I've heard of double materiality so far. So thank you.
It goes with the hands inside out and the outside.
Charlotte, can I ask you, I mean, you had the responsibility for negotiating the taxonomy for your country, for France. Perhaps you could just share a few thoughts around the supervisory framework, particularly how you see how it's evolved from where you sat round the table now that we're in the process of implementation.
Thank you, and thank you, Daniel, for the invite, and thank you also to all of my colleagues from the supervisors for the very relevant comments. So I'll try not to repeat too much what's been said already, but it's true that I think when we started the negotiation in 2019, in 2018 actually, member states, parliamentaries, even the European Commission itself probably were not on the line of, you know, I mean, the taxonomy was defining green, and that was it, to make it simple. And its role sort of like evolved over time, over the negotiation, because now in the taxonomy, that's why I'm never saying actually that it's green. And if there are some French financial market participants around the table, it will sound familiar to their ears, but I'm always saying open up the taxonomy and you have activities, actually you have sectors of the economy that are the most carbon intensive right now. And I think that's one of the many strengths of the taxonomy, is that it's including not only technologies, I mean, activities where low carbon technologies are already available, but also activities where low carbon technologies are not yet available. And the taxonomy sort of like sets the objective to be met, or at least a first objective to be met, though it's not necessarily the one that gets you directly to carbon neutrality. And so I think it's very important to have that in mind, considering that the taxonomy not only defines green and allows to sort of like share a common language of what is sustainability, but it's also the common language of what is transition. And as such, it's both, in our view, a reporting tool, of course, because Article 8 sets reporting requirements, and the representatives here from the ESAs have talked about that extensively, but also a reporting tool because it's feeding into the reporting of financial products, and not just sustainable financial products, actually, because products that are neither bearing ESG characteristics and nor having a sustainable investment as an objective actually have to include to what extent they're not taking into consideration the taxonomy in their pre-contractual and periodic documentation, which is a big step forward. So it's a reporting tool, but it's also a transition tool. And I think that a lot has been said about that already, but just to mention that because the taxonomy sets the objective to be met, it's also allowing not only to give an information as to where is the company right now in terms of achieving carbon neutrality, but also having an information to actually accompany that company into carbon neutrality. And that's a big step forward. And as such, we think that in terms of supervision, I think it all comes down, at the beginning of the day, let's say, to the competence actually of regulators and supervisors also, because the concepts that are embedded into the taxonomy are not that simple. Actually, we hear a lot, not only in France, I'm sure everywhere, that, for instance, net zero would be more ambitious than the Paris Agreement. Actually, net zero gets you not to overshoot the temperature objectives of the Paris Agreement because of like greenhouse gases inertia in the atmosphere, for instance. I mean, that's a very basic principle in climate science, but that's not understood by everyone. And of course, it's not just to throw the rock at anyone. It's just that there is a need for much better skills about what is the ecological transition, what is the energy transition. Actually, if you want to understand the taxonomy, you need to get that. And so from a supervisory perspective, if you are looking at the substance of financial products, and if you open up the book and you'll see that there's a need for much better skills from supervisors on that end. And I think that's the first supervisory challenge, actually, because it's not only about the quantity of information that you publish and how you publish it, it's about the quality of information, especially as regards financial products. But we could also say the same thing as regards Article 8 and the fact that all corporates, above 500 employees will have to publish taxonomy aligned information. It's also the fact for credit institutions. I mean, if you look at the delegated act under Article 8, you'll see that there are probably 10 pages about the green asset ratio that banks will have to publish. And we think it's a fantastic step forward, but actually how exactly are this type of information going to be supervised and controlled as regards, for instance, especially the trading book of the off-balance sheet. I mean, parts of the activity of banks that is not that easy to actually screen against the taxonomy. And we have that issue, for instance, for green bonds, for sovereign green bonds and all that. So I think it's very important to have in mind that it's both a transition tool and a reporting tool, because that feeds into many supervisory related challenges. Maybe just to quickly finish about that, because I hope not to be too long, but we think also that it's very important to have in mind that if we are to develop further the transition feature of the taxonomy, and I'm thinking especially about two sides on the same coin. I mean, the first side of the coin being developing indicative sectoral trajectories, and the second side of the coin being having much better transition plans from companies. We have the Kpis plan that has been proposed so far by the Commission, and actually the French Treasury has replied to that delegated act following a non-paper we had circulated to the Commission last spring on reinforcing that Kpis plan with more substantial information about what is actually done in terms of transition, because it's not only about the Kpis you put on the table, it's not only about the governance of the Kpis plan, it's also about the maturity of the technologies you are contemplating for actually ensuring that you are going to get to carbon neutrality. It's about the decarbonization levels that are expected in terms of different industrial processes that are within the company, and which you might expect that if you put more investment expenditure there, then it's going to decarbonize substantially because you are going to acquire low carbon technologies or be able to decarbonize how to abate processes. And all of that, in our view, is very important, of course, that companies can publish that, because of course, having a low alignment against the taxonomy right now is an information that is useful per se, but it's not the whole information that can actually drive the financial sector to help finance the transition. And I think that's a very, let's say, hopeful thing to say politically. And actually myself, even I've worked extensively on that topic, so I won't negate that. But when it comes to supervision, when it comes to auditing, how can you audit trajectories for alignment? How can you audit the fact that it's not only an obligation of means, it's an obligation of results that the company is kind of putting out there? And there's a real need that the CSRD, the FRD revision actually tackled that topic, because it's an auditing topic at the end of the day as well. I won't be too long about that, because I could talk about that for hours, but maybe just on the third point that sounded actually very familiar when a colleague from the EIOPA talked about that. It's about the fact that the more you reinforce the transition feeder of the taxonomy, the more you actually contribute to the management of transition-related risks. Of course, the taxonomy initially has not been built as a risk management tool, but it's one tool amongst others that can help you out to do that. And the fact that it's progressively being integrated into the Prudential framework, on pillars 2 and 3 in particular, is a very good thing. But by reinforcing that transition feeder of the taxonomy, you would offer also more leeway for supervisory authorities to, and also actually to financial market participants themselves, to actually assess climate-related risks and transition risks in particular. And we think that the fact that that transition feeder could be reinforced would actually make a positive contribution to the EBA's current work on drafting ITS, specifying the format and the instruction for Pillar 3 disclosure of prudential information on ESG risks. And as such, we think that providing access to information on the alignment of decarbonization pathway aligned with the EU taxonomy of borrowers, of investee companies, of counterparts as a whole would actually facilitate the assessment of the climate risk, at portfolio level, because you would sort of like assess to what extent the company is far away from its low carbon trajectory. And that's putting at risk the credit institution that is actually holding that company in its portfolio. Of course, I'm simplifying a lot about what is risk management and how you actually assess transition risk, but that's sort of the idea behind that. And I think that's another supervisory challenge that, whether we like it or not, is going to have to be tackled in the forthcoming years, considering the importance, of course, of physical risks, which we do not even have to talk anymore about, to discuss, considering they are already here, but also transition-related risks.
Thank you, Charlotte. Maybe just I think there were two things that you highlighted there. The first was the challenges that I want to dwell on, and the second is more around the supervision. But if I take the challenges first, but perhaps I can go in reverse order that I did before. So start with Pamela and Alessandro, and then Fabien. What are the main challenges that you see at the moment through each of the supervisory authorities in regard to the challenges of the taxonomy? Pamela. I say the main ones. I'm sure there's going to be loads, so just maybe the main ones.
You should see my brain. It looks messy. Well, the very obvious challenges are, of course, I think the timing of the disclosure. I mean, that's not really aligned yet. So when will we have the first disclosures by the the market participants, which can then feed into the financial market ratios? So that's maybe timing. Then, of course, the data. And then I've touched, I think, one of the, if we want to talk really about the supervisory challenges, I'm not talking about, I think then the supervisors will really have to establish their role. What is their role then in supervising the sustainability? Because, I mean, I'm definitely not a climate scientist. I'm hardly an insurance specialist, let's say, to be very, but what can we then say as supervisors? We have to check the risks that are to our companies. So what we did is, as a supervisor, we do a transition risk analysis. We've published that. Now we're going to do a physical risk analysis. We're conducting that. We're going to collect evidence. So that is what we feel most comfortable with. But once it comes to really the consumer detriment of greenwashing, I think this has not been discussed enough, because there will be a lot of data around it. And who will in the end be holding the bomb when the bomb explodes? And I hope the supervisors will not be holding this, where we see that actually there has been a lot of, A, we don't reach the climate agreement thresholds, and B, actually what is in the portfolios is a scam. So that's, I think, a big challenge, but just to name those, and I've probably missed many of them. Thanks.
Thank you. Alessandro or Fabien?
I concur with what Pamela mentioned. I think there is one fundamental issue that sometimes escapes to most when reading the taxonomy regulation, even that there is no designated supervisor under the taxonomy regulation. What you have in terms of supervision is under sectorial legislation, which may or may not be linked to the taxonomy regulation, and you have supervision, obviously, of the disclosures relating to the taxonomy. But there is no explicit business conduct supervisor under the taxonomy regulation. So when it comes to assessing whether a company is or not taxonomy aligned, whether this is the trajectory of which a company is, etc., is the right one or not. Obviously, there is no supervisor there. So the role, I think, and I speak from the perspective of securities regulators, from our side, is one of investor protection and stability. Most importantly, from the investor protection side, transparency of disclosures is fundamental. And here I do see the point that Charlotte mentioned about education and training. I think supervisors are very much accustomed to assessing financial measures and financial metrics, but it's a bit more of a challenge assessing climate-related measures. So that's definitely a challenge we'll need to face, and also our national authorities will need to face. One other aspect in terms of challenges I'd like to mention is clearly about the level of responsibility that management takes within companies about the whole taxonomy regime. The risk with setting public policy objectives through disclosures is that there is not necessarily the immediate involvement of senior management and senior executives in companies. We do always, and I'd like to do it today as well, reinforce the message that taxonomy assessments are first and foremost a strategic matter. So the question whether a company is taxonomy aligned or not, obviously is a factual exercise, but it needs to be part of the top management assessment, and especially when it comes to trajectories. Is a company on a trajectory towards becoming taxonomy aligned, yes or no? Well, that's a strategic decision that needs to be made. The other point also Charlotte mentioned that, but I'd like to re-emphasize it as well, is assurance. The Article 8 disclosures refer to the non-financial statement under the NFRD, which, as we know, doesn't provide for a very stringent regime for assurance. So until the CSRD is in place, we need to acknowledge that for a few years until then, there will be no or very limited assurance around the figures published under Article 8 of the taxonomy regulation. So that's something that needs to be highlighted, and that has knock-on effects also on supervision, because I can mention that in some member states, supervision is closely related to the assurance regime. Perhaps two last points on the challenges. One is the role of SMEs. In this whole picture, the disclosures under Article 8 at the moment are, again, for large entities. It will be perhaps a bit better when the CSRD kicks in, because the scope of entities will be enlarged. But still, when we look from the asset management perspective, and this perhaps is very similar for other financial institutions in the market, SMEs need to be part of the taxonomy regime in one way or another. Otherwise, larger companies, asset managers, will be unable to discharge their disclosure obligations, but also more fundamentally to channel investments towards sustainable investments. So this is something that perhaps is not necessarily or directly a supervisory challenge, but clearly is an investor protection challenge that we are observing. And the last one is about preparedness. I want to emphasize today that it is true that we've been talking about the Article 8 disclosures, but in general, the taxonomy regime is new, but it requires companies to immediately think about structuring their data collection, the risk management systems around the taxonomy concepts. Otherwise, it will be rather difficult, or well, it will be impossible to discharge their obligations under Article 8, and it will be rather difficult to be part of this transition. So preparedness is something that we are facing ourselves from the supervisory angle, but we very much emphasize it's important for companies and financial market participants to get ready and get on board on this taxonomy regime. Thank you.
Thank you. You raise a lot of issues. I won't come back on all of them, but I think the optimistic side of me thinks that if we go back before the financial crisis and the concept of micro versus macro prudential supervision, for example, I mean that came from nowhere to be quite a prominent feature in most of the areas across the world, certainly on the banking side. But I think there needs to be this transition. It may take a while, and maybe in the interim, it's the updating of supervisory guidance on the latest assumptions people need to make, which becomes very difficult. And then I think it touches also on an issue that Pamela kind of hinted at, which is if something goes wrong, what is the supervisor's role in this? If there's if there's investments in a particular area, and then actually there's been a change of mind, but the supervisor in some sense had kind of encouraged that, you get into a whole lot of other issues actually. Fabien.
Thank you. I don't have much to add to what my colleagues already pointed out as challenges, but perhaps just to emphasize some of the points already mentioned. I think the first challenge, I very much agree with what Charlotte said, that there is a need to build capacity, understanding, and expertise around the taxonomy. This is a new tool, so I think everyone needs to get familiar with it to understand what it is and what it's not. And I think it's true for institutions and for supervisors and regulators. Of course, there is a challenge for, if I talk from the banking sector perspective, there is a challenge now to be prepared for implementation. And by implementation, I mean primarily disclosures and being prepared to disclose green asset ratios going forward. And it will be hard to ignore challenges around data and how institutions will get the data from their clients and counterparts. Pamela mentioned the timing and the sequencing issue, which is becoming very prominent in the discussions. But at the same time, I think the challenges have been discussed quite a number of times and in other sessions. At the same time, there are also actions that can be taken by institutions and by public authorities to help smooth this process. For example, from a banking perspective, banks are in a position also to start collecting information by engaging bilaterally with their borrowers and counterparts. And Alessandro mentioned also the need to start adapting the information collecting systems, the IT systems, so being prepared for implementation, and that involves assessing the data needs as soon as possible, and then starting to take actions to bridge these data gaps. And by the way, this is true for the taxonomy, but this is also true for ESG risk management, and this is something that we have highlighted in our reports on the need for banks when they will have to manage ESG risk, and they will have to assess and to identify this risk as soon as possible. And when originating loans, for example, or when monitoring your portfolios, those are moments when you have to assess what are the data gaps and what are the actions you have to take to bridge these data gaps. Public information will be key, and there is a momentum, I think, now in terms of sustainability reporting. Commission's initiative with the CSRD and with the European Single Access Point will be very important. The EBA has also proposed, as part of its advice on Article 8, but also as part of the Pillar 3 draft proposals, to make use of proxies and estimates in certain cases when data is not available yet. For example, this can include the use of EPCs for your real estate portfolios, or of coefficients when data from counterparties is not granular enough. One important aspect also to be taken into account is a sequential approach. So, for example, in the Commission's draft delegated act on Article 8, there was a proposal already to start disclosing the KPIs in 2023, so which provides some leeway for next year, for 2022. We also propose to have a review clause in a few years to assess if the scope of disclosures can be enlarged, for example, to additional asset classes for which it's difficult at the moment to assess the taxonomy alignment. And I think also qualitative disclosures will play a role in terms of providing context to stakeholders about data challenges that are faced at the moment, and which can affect at least the first reporting data points that will be reported in the first years of implementation. Okay, so just wanted to highlight that, yes, there are challenges. It would be hard to argue that there are no challenges around data, but there is also a range of actions from institutions and from public authorities that can be taken to smooth the implementation process.
Thank you. We've only got a few minutes left, so I just want to I'll ask a question that's come in, I'll relay that, but also just a further one, and then maybe combine these with sort of concluding remarks from each of you, starting with Charlotte. If you look at the last financial crisis, those banks that did well were those who had extremely good risk management, and that was a massive differentiation between the two. And part of this is around, it becomes therefore very proprietary how you manage your risks as a firm. If you look at the more sophisticated financial firms at the moment, the amount of material they have put out the last 12 months around pandemics, with scientists, with whatever, to their investors, then and ESG is also in that area. So there's a massive focus now on this area in the investor community and the large insurers and banks across the world. But basically, it's going to be very, very challenging for the supervisors to keep up with the risk management that's going on in these very sophisticated firms. And I think one of the things that you've touched on here is, for the smaller firms, it becomes really very difficult indeed to adjust in some sense how they're going to run their financial institution, because this will impact, these metrics will impact how firms operate. So I think really it's how do you further the sort of supervisory element of this? It's going to be very difficult over the next few years. And in some sense, again, if you look at the last financial crisis, the supervisors had no idea what some of the firms were doing in the run-up to the current financial crisis. The second one is the question that's come in is about in what terms do you see an issue to recognise greenwashing for the supervision, especially in light of the different times at which various pieces of legislation came into force. So I ask those two together, and maybe I could start with Charlotte, and then Pamela, and then Fabien, and then lastly Alessandro.
That's a tough one, actually, Daniel, because I think this is the topic probably of a whole session. But I mean, I think in terms of risk management, I mean, we talk about that extensively actually with the Paris marketplace. Of course, it's not an issue of saying that climate-related transition risks. Climate-related risks are actually more important than other types of financial risks. I think the issue is to understand that they're feeding actually into common financial risks, and that in this view, they need to be tackled appropriately, and they need to be measured, and they need to be common methodologies. And I think that the way you can do that by using the taxonomy is actually sharing again that same language of what is a transition. I mean, what is actually a company that is on the right transition pathway? And of course, we could always argue that there are some social issues related with that, and they are, and I think they add in actually to the transition related topic. But I think it's all an issue of trying to share. I mean, it's not all, but it's at least an issue of trying to share the same methodologies and trying to be transparent about that, the same way that after the crisis, actually, there was a whole new level of regulation in terms of risk management. I think now the next frontier is actually the one about climate risk. And because it's not, I mean, of course, it's a long-term risk, but it's not because it's long-term that it's not happening right now. And I think there is a supervisory need to tackle them as soon as possible in this view. I'm trying to remain very general because there is so much to say, but it's all related, of course, to data challenges, and my colleagues from the ESAs have pointed that out. It's related also to the way you can assess all that outside the European Union. I mean, we talk a lot about how can you assess the taxonomy related criteria for subsidiaries, for instance, that are located outside the European Union, but apart from taxonomy related criteria and apart from subsidiaries, it's actually how can you share that common framework to assess the company based in the Philippines from a company based in France, for instance. And so, and it's very relevant in terms of risk management as well. And I really would say that a lot is happening in terms of methodologies, and there needs to be more international conversions on that. But that's just a phrase I'm saying because I think it's very important to bear that in mind, and all efforts must be put together to do so. So I remain very general on that end, and thank you for all that.
Thank you, Pamela.
Yes, and these are two nice questions. And on the greenwashing, I think if I understand the question right, it's typically the question, when should I start changing my asset allocation in my portfolio? Because I might be the best in class today, and then all of a sudden the regulator changes its mind, or even consumer preferences change. And then I will be looking sad, and I will have lost money. And we do acknowledge you can't change your portfolio overnight. And as insurance supervisors, we know that better than ever, because they're long-time commitments, sometimes over 10, 30 years. So, but that is essentially the transition risk that you run. That's the definition of transition risk, that consumer preference or policyholder preference change. And you are not capable to predict what government will say. We've seen that in the pandemic. And that's this predictability issue. That is not possible. But what you should keep in mind, and I think that's the lawyer speaking here, you will have to assess the actions, the risk management actions of a company in light of the applicable regulation at the time, or the expectations that were set in good faith. So if nuclear today is this color and tomorrow it's another color, well, that's how you can also react as an investor. So you have to take that in good faith at the time of investment, knowing that indeed, as Charlotte says, it's a transition effort. But nobody says that it will be it will not cost money. But I think, and this is maybe more ideological, but let's not forget, I think companies will be more blamed or will be punished in the end by the consumer if they do nothing rather than doing something that in good faith reflects the expectation. So that was on this greenwashing and being punished for being the first to change. And then I think when I heard the term proprietary, maybe I'm missing the point of, but there is this, indeed, there are a lot of advanced risk management tools that are being developed, and it costs a lot of money. And I think Alessandro also mentioned the SMEs. There is one very concrete work we're working on. I mean, we are asking insurance companies to do a scenario analysis of climate change risks. Well, we say that, and we know the NGFS has been working on scenarios, but we are really aiming to give guidance to companies to do this scenario analysis by developing dummies. And we hope that by the end of this year, we can give some clarification. So that's definitely a responsibility we have. You can't just say, do this and not understand as a supervisor yourself or provide guidance, especially for smaller companies. And then on the proprietary aspect, but we can't discuss that fully today, but we've been discussing many times and with the Commission, and you will see that reflected also in the taxonomy. To make the loop back to the taxonomy, there is in the technical screening criteria, in order to be eligible for as a non-life insurer, you should have some commitment to share data with public authorities. And that feeds into your risk management. I mean, who says that data, and here I'm being very provocative, who says that the amount of losses that happens over the world or in Europe, and the exposure, the money, the monetary, is something that is owned by insurers in that sense. It's the business. It takes a lot of effort and a lot of time, and something has to be, it should be a give and take. But we need better information on the risk management, on the data that companies, not only insurers, but any type of scientific institution have to assess the risk. Because like in the pandemic, you make the link to the pandemic, it's the modeling of all these socioeconomic risks. How do you model that? And nobody has the set of data. So if we can achieve a more open source, opening a bit this proprietary approach to that type of data, we could have a better risk prevention or an alignment of risk prevention measures across society. Thank you.
Thank you. Thank you very much, Pamela. Alessandro or Fabien, whoever wishes to.
Okay, I will go. Just to add to what has been said on the taxonomy, I think also extending the scope of the taxonomy, not only to other environmental objectives, but also to significantly harmful activities and low impact activities can be useful for disclosures, but also from a risk management perspective. In terms of risk management more broadly, for the sake of time, I will just highlight that in the report we have published last week on the risk management of ESG risk for institutions, there is a range of, there is a description of available methodologies that can use to assess ESG risk. There are also actions that we ask institutions to take as soon as possible, including incorporating ESG risk in business strategies, incorporating ESG risk tasks and responsibilities in governance structures, managing this risk as drivers of financial risk, as Charlotte described, in their internal capital adequacy allocation process and in the risk management frameworks. And there will also be a need to incorporate ESG risk in the supervision. So we have included a proposal for a phase-in approach, starting with assessing the the role of ESG risk in the business model analysis in governance, and later on progressively and proportionately integrating this risk into the supervisory capital assessments, also pointing to the need to continue developing data and methodologies for, in particular, when it comes to quantification. So for the sake of time, I will just stop there. Thank you.
Thank you. And then lastly, Alessandro.
Thanks. Just briefly, and I concur with what most of that has been said already on greenwashing. That is a want to be to sort of. I think we need to be direct. That's indeed a challenge more than in the past years because the market is pointing to the direction of sustainable investments, but at the same time, the regulation is not keeping up with the pace of the market. So that's a challenge to which I think the best tool that we have as market participants and supervisors is transparency. Transparency will knowledge come through clear disclosure requirements, which are building up. So it is important that I think market participants are attentive to what is put up by issuers out there. I'm confident, though, that we are in a better position than a few years ago. I mean, green bonds have been around for some time, and now investors are in a better position to assess what is sustainable and what is not in a perfect position, but in a better position. So I think this is something that definitely will continue to monitor, and we are monitoring this type of risks and trying to also get to a converged understanding with the national authorities of what greenwashing means. And this would be the starting point to more converged supervision also in this area. On risk management, I think it's a good development that's based on also the advice that ESMA gave. There were amendments to use its MiFID, IFMD, delegated acts, which point to risk management and ESG in risk management and processes in the relevant institutions under those directives that I mentioned. So this is, again, an additional tool which puts us in a better position than what you mentioned, Daniel, compared to the financial crisis, for example. But indeed, the issue of the tools, availability of tools, the cost, that remains. I think third-party providers can help the smaller entities. There we need to be careful because these third-party providers may be at the same time ESG rating providers, data providers, etc. So we need to have at some point regulation or at least some form of Chinese walls between the consulting service that these entities provide and the rating or data provider service. And we're not there yet. So this is something that we need to achieve.
Thank you. I wish we could keep going. Actually, you keep between you all, you keep raising additional points that I would love to come back on. But can I just thank you all very much for your time and sharing your thoughts. It's a fascinating area. In some sense, you know, what the work that's going to be done in the ESAs is going to impact the entire European financial sector and beyond. So I just appreciate you being able to share that with the attendees today. So thank you.